Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Hello and welcome to this episode of the Australian Finance Podcast. We've got a bucket load of questions to get through, everything from investment bonds to using shares or blue chips versus ETFs. And as always, joined by Gemma Mitchell. Gemma, how are you going?
I'm going great, thanks. How are you?
Good, very good, very good. Very happy, I should say, to be getting stuck into plenty of questions today. I've been sick for a few weeks, so glad to be back and glad to be seeing so many questions come through.
Yeah, it feels like ages since we've done a Q&A together. I've had Tylee on the show. Last week I had Mitch on the show. So yeah, it's been a hot minute since we've actually done one of these.
Yeah, and so now you've got your third choice. But I'm grateful.
Slumming it back with Owen.
Yeah, yeah, that's it. But we've got a lot of questions that we want to get through today. You made a promise to people on social media that we're going to get through 10 in one session, and given how you and I like to talk.
Yeah, so I've already warned Owen that these are rapid fire and that he needs to keep his answers very, very short. So I'll be giving him the hurry up. But yeah, so many great questions have come through. So I put the call out on our socials for any questions. So we usually get them through the podcast player app, which is great. And we get so many good ones. But I thought I'll just put it out on social media for people that follow us there. And yeah, lots of great ones came through. So excited to get into it.
Cool. But quickly, before that, what have you been working on? What's been happening lately?
This week, always book stuff. The Money Reset coming out in a couple of weeks. But excitingly, I've been working on, we are doing the Ladies Finance Club Summit stuff. Yeah. So for those who don't know, the Ladies Finance Club Summit, online summit is coming up on the 29th of August. And Owen and I are doing our segment, I guess our presentation is on how to retire with 100,000 more without earning anymore. So I've just been playing around with numbers and scenarios and doing some cool stuff for what we'll be presenting. So that's been pretty fun, diving into some different scenarios. So yeah, I've been playing around with that. What have you been doing this week?
Recovery mostly from being sick. Turns out, I spoke to a doctor this week. Turns out flu A is the one you don't want to get. If you have the choice. So don't get that one.
Which you rarely do have the choice.
Yeah, but you never know. You can wishful thinking. But no, just catching up on a lot of stuff. We're doing a few more shorter podcast episodes, which is really cool. And the traction on that has been insane, particularly on YouTube. Like we're seeing YouTube really grow. For so many years, Rask, people will probably pick this up, but for many years, Rask hasn't done a lot of social media and a lot of YouTube. Like we've always had YouTube videos, but now 35% of people watching a Rask podcast do it on their TV, which is crazy. Yeah, crazy. Like when you think that's 35%. So people like me just put it on at home and watch it on the TV. So kind of cool. Yeah. But other than that, really not that much, just trying to save some more money, hopefully, and invest a bit more, and that's about it.
Yes, well, maybe you'll learn something out of these questions today to help you save
Maybe. Yeah, cool. I should do the disclaimer then, shouldn't I?
Absolutely.
As everyone knows that listens to the show regularly, anything that we do say on this podcast is strictly general in nature. It's really important to understand that when we answer your questions, we do so with a general advice framework, because in order for you to get personalized financial advice, you should speak to a financial planner who can take into account your needs, goals, or objectives. So anything that we say, don't act on until you've spoken to your financial advisor. And at the very least, if we talk about things like ETFs or super funds or insurance, they come with something called a PDS or product disclosure statement, which you can read on the provider's website. We also have a financial services guide available at rask.com.au/FSG. That's it. So maybe you're the one that collated all these questions, and I've got a heap. I'm kind of looking all over the place because there's got different tabs open with different questions. But yeah, over to you, Jim.
Yep. Okay, great. Well, let's get into it. And remember, No talking all day. We know you love to talk, but this is rapid fire.
Okay.
Okay. And now, we always like when people send in their questions to have funny names, usually, but because this came from social media, it just had their names, so I'm not going to call out any names. I've just got the questions, okay? So apologies, but people will know their own questions.
Yep.
All right, first one. Are investment bonds actually a good option for people in their early 30s?
No, it's not about age. It's about incomes and future incomes. So investment bonds, just for a quick one for people that don't understand, it's like an investment account, except that bond is taxed in its own right. So it doesn't go into your personal tax return. It goes into its own tax return. And the big benefit for people, provided they don't stuff up on the way through, is that after 10 years, it's effectively tax-free. So you can pull it out and you can use the money. Really good for kid planning, like for family planning. But the data seems to suggest that you have to be on a high income and stay on a high income for many years in order to make it really worthwhile. That's my 2 cents.
Yeah, I'm exactly the same. I don't think it's age relevant so much. It's more about your income and your time frame that makes it, would make it worthwhile if you'd be considering one. Yeah, so if you're a high income earner, you would consider it.
Do you have one?
I don't have one, no. But one of the questions is what I do have and why I have it.
Okay,
so if we
we'll
get to number 9.
Yeah, number 9. Wait for number 9, everyone. Okay, so what you do have. Got it.
But yes, I think this is relevant for kind of all strategies. Is I don't really think that there's things that are like age appropriate. It's more so, does it tick all the other boxes? Tax, income, all of the other things.
Goal setting, yep.
Yeah. Perfect. This one wasn't really, this is kind of seems more like a statement, but I think there's a question in there that we can assume. Investing through a bucket company if you're a high income earner. So we're assuming, do they mean, is this a good idea?
Yeah. So another tax investing related question. There's 3 of these today. A bucket company. So I just mentioned that an investment bond is taxed in its own right. It pays its own tax. Someone else manages that for you and you invest through it. A bucket company, for people that aren't familiar, is just a company that's set up to do your investing for you. So it might open your Perler account or open your stake account or, whatever. It's like a company. The difference between company tax and individual tax in Australia that everyone should know about is that when you invest in, say, shares in your own name, you are eligible for a capital gains tax discount. What that means is if you hold your investment for 12 months, if you made a $100 gain, for example, you only pay tax on $50. You pay half, like tax on half. With a company does not have that same entitlement. So you'd lose that potential, but instead what you gain is a 30% tax rate. So if you're a high income earner, you're paying tax at 45%, you're probably thinking, well, can I just open the account in a company and invest that way? Yes, you can. Is it right for everyone? Absolutely not. Like, you've got to have the right circumstances. And I think when we do get to question number 9, we'll come back to this because it will make more sense why you would use this bucket company. But I've got one and I'll explain why when we get to question number 9. Jem, what do you think?
Yeah, so I think this is where having a good accountant or financial advisor and a really clear plan on your capacity and where you are now, where you want to go is important, because right now it might not make a lot of sense, but it might be like, well, how much I'm planning to save, invest, and what the wealth I'm going to build in the long term makes a lot of sense for me to have this structure. So you need to kind of map out things and work with a really good accountant and a really good financial advisor.
Yeah. There are certain circumstances that make this worthwhile, but there are so many other options: super, family trust, investment bonds, so on and so forth.
Yeah. And it's like, a good advice. So accountant and financial advisor makes it really so worthwhile, because you just don't know what you don't know, and you need to model out a few different scenarios of what it looks like now and what it's going to look like where you're trying to get to. Question number 3: how do you build wealth on an average single income?
Well, that's a good question.
A really good one.
So what would be an average income, do you reckon, today? What is the average income? I'll do a Google while you do that.
I looked up this recently, and I think it was like in Australia, kind of like 80 to 100,000 at the moment.
All right, I'll bring it up for everyone that's watching. You reckon 80 to 100? I reckon like 77. I don't know why I just picked that number. It sounds pretty good. So let's go. Here we go. Average
Oh, nice plug for my
wage.
book just there.
There was a little money reset there just on Amazon. I just brought it up before. You can get it 25% off on Amazon. There's Gemma's book, The Money Reset. Take
Probably
control.
somebody on an average single income probably should buy that book too.
If you're on an average income or above or below, you should get this. So average wage for full-time workers in Australia is approximately 102,000. What?
Nailed it.
That's according to REL Executive. That doesn't make any sense. ABS data, 88,000. So you were right.
Yeah. It's almost like I've looked this up before.
Yeah, jeez, wow. Good memory.
Yeah, so I would say commonly like 80 to 100,000, but we know that like there's such a variety, right? Like there's so much that skews that, and that's still a hard slog to live off. Like right now,
I mean,
right?
if you're single and you've got to save for a house, or you've got rent, or you've got kids, or
with average rents and average groceries and things at the moment, that's not going very far. So
So how do you build wealth? How would you do it? Give us some tips.
Oh, I'd buy the money reset. So the basics, right, are the getting your foundations right. It's like spending less than you earn, which honestly can be very hard these days. It's easier said than done. But having strong daily habits, knowing what your expenses are and having good discipline, knowing what is discretionary spending, what's wants versus needs. Those daily habits are just so important. What are your tips? I know you've got a video that just went out on this.
Yes, I do. So for people that don't know, I haven't read Gem's book yet. I've got it in the office now that I've come back from being sick. And chapter 6, according to Amazon, is boosting your income. So there we go.
There is a whole chapter on it because the book talks about levers, right? And one of the levers is spend less. But that's not a lever that everybody can pull. You might be spending the absolute bare minimum and not be able to spend any less. So the lever that you might have available is you literally might have to earn more. And that might be returning to paid work. It might be increasing hours. It might be doing a side hustle, like changing employment. Like it might literally be you have to increase your earnings. That is one of the things in there that's in a chapter.
Cool. Just my 2 cents quickly on this. So I think there's 2 magical numbers that you got to keep in mind. Number 1 is 100,000 and number 2 is $1 million. There's a certain formula to get to $100,000 of net worth, and that revolves around saving more money. So when I say saving more, I don't mean just like cutting expenses, exactly what you said, Gem. I mean driving a wedge between what you earn and what you spend. If that means earn more and spend less, or earn more, spend the same, you're going to be saving more. So save more to get to 100,000. From 100,000 to $1 million, that's where you have to get creative. We've done a full video on this just recently, a podcast episode. If you haven't already listened to it, it's an absolute banger, if I do say so myself. We put a lot of time and effort into that. And basically, once you get to 100,000, it becomes about things like how do you use property? How do you use leverage? What investment returns are you targeting? Those types of things become way more important. So average wage, absolutely you can retire on your terms. If you need any more inspo, check out Dave Gow from Strong Money. Forklift driver, retired before 30. It can be done. Get creative and try to enjoy it while you do it. So that would be my tip.
Perfect. I'll link that episode in the show notes of this one. Number 4, could you provide the reason for the active ETF in the Jupiter investment, so that's the Rask investment portfolio, given it's for under 5% of the asset allocation? Yeah,
so this is a great question, and it's a good point because a lot of people know that we love ETFs and index funds, which are quote unquote passive at Rask. But we don't just use ETFs and index funds at Rask. That's really important to understand. Like if you invested with us, which a lot of people do now, which I'm very grateful for, you don't just get ETFs. There are other things in there, but what they're particularly talking about is they're talking about one of our holdings, which is classified as an active strategy, which is the Lakehouse Global Growth Fund ETF. And so what that means is that we've chosen this one fund manager that we think is like exceptionally good. So they're good enough that we think that they deserve some of the place that would normally go to an index fund. We think they could outperform that. Now, the reason why it might be 5% and not 20% is because they run a very concentrated portfolio. So We invest in the S&P 500 ETF, IVV. Most people know that. That's got 500 stocks inside it. This fund manager has a couple of dozen, right? And the top 5 stocks are worth the majority of the portfolio. Last time I checked, it's like a substantial amount. So we can't just go and put all of our community's money into that one thing and expect it's going to be always great. Second thing to know, and I really just wanted to make this educational point, is I think people understand that index funds should be like a majority or at least a big part of your portfolio. But at what point does an index fund no longer be an index fund? And I ask this sincerely because in our strategies, we also have ATEC from BetaShares, which disclosure is a sponsor of the show. ATEC is a technology ETF that has a few little quirks and a few little rules in it. Is that still an index fund? Is it active? Because I'm making an active decision to include that and not VAS or not whatever. So I'd probably leave people with that and say that what is active and what's passive, I don't really care. What's an ETF and what's not, I don't really care. I just want to go for the best investments regardless of what their label is, so to speak. Does that make sense, Jim?
Yeah. Yeah, absolutely. I think that's, we can overanalyze, or actually in that case, we can underanalyze how much actual thought was put into a portfolio construction.
Well, yeah, definitely. And we talk about this a lot on our Investors podcast, that ETFs and index funds are fantastic. And if you're a beginner, use them. Absolutely use them. But as you get older, as you get retirement, your portfolio gets bigger, get a bit more sophisticated. Serious, because the last 5 to 10 years have been really good in the stock market, particularly for US technology stocks. I saw an interesting study the other day, Jim, just quickly, that showed if you excluded just the 10 biggest stocks in America, Microsoft, Nvidia, Apple, Tesla, those companies, the 10 biggest stocks, the actual profits of the other 490 haven't gone up since 2021, 2022. So the other 490 companies haven't grown in that time, but it's just those top 10. So it's important for people to it's important for people to understand where their returns have come from and where they might come from in the future.
Yeah, and not to be too complacent.
Yes.
This is a very great lead-on question from that then. So can you explain to us what decides, or how is it decided, what makes up the top 200 in the ASX? So the ASX 200. So I was going to say it's the biggest or the most traded companies in the ASX.
Yeah. So, okay. So yeah, it is.
There's quite a lot in there that goes into it, but that's like the easiest kind of way to explain it.
100%. Yeah. So the easiest way to explain it is exactly what you said. It's the biggest 200 companies, but there's another kind of rule in there, which you also mentioned, which is most traded. This is the thing that people don't understand, is if you think about a company, like let's say a company like Xero. Xero was founded in New Zealand. It's important to understand that anything that's good from New Zealand, we tend to claim as Australian. So this is one of those things. So, actors, maybe some of the actors they can have back, but a few of the actors, a lot of their technology companies are like, hey, it's Australian.
Food, everything.
Rod and gun. And then the New Zealanders are like, hold on a second, mate. That's a Kiwi thing. Anyway, so Xero started in New Zealand, but what they quickly realized is that they needed to expand into Australia. So what they originally did was they had their shares on the New Zealand Stock Exchange, but also on the Australian Stock Exchange for quite a while. Now it's just Australian Stock Exchange. But what ended up happening is when it came to Australia, a lot of the shares were still overseas. So even though it was listed on the Australian Stock Exchange, it wasn't included straight away in the ASX 200. So this is an important thing for people to understand, because even though you might see the shares in Australia of certain companies, they're not always included in the top 200 because there are other rules. A good one is sometimes founders own a lot of their company and they don't trade those shares. So it's not included in the ASX 200 because there's not enough trading activity. That's that second rule that we mentioned. But for the most part, if you're just starting out investing, the way to understand the ASX 200 biggest companies ranked by the total value of all the shares.
That's why you see things like your CBAs, your BHPs, all the big companies that you know and that you see regularly. That's why you see those. And now the other thing that they said is what and how it decides. Now that is reviewed every quarter. That's right. Yeah.
Yep. Yeah. So it's every quarter that it's calculated again.
Checked again. Excellent. Now, do you have to have a lot of money to engage a financial advisor?
Good one for you, Gem. Do
This
you?
is a good one. Okay. So no, you do not. You can get a lot of value out of seeing a financial advisor at any stage, but it will cost you a lot of money. So while people can get a lot of value out of seeing an advisor, they tend to hold off until they have a lot of money because it feels more justified with the fees. But if you can afford to see one at any stage, that would be amazing. But there are fees involved. So that's why people wait, and why advisors even say, wait till you've got more super or more investable assets, because it does cost quite a bit of money, but there is a lot of value in it.
Absolutely, there is. Yeah, I was thinking about this question on the train ride in this morning. It's 3 degrees in Melbourne today, by the way. For everyone in another state, yeah, we cop it. Don't worry.
I do have my UGG boots on Sunshine Coast. It's terrible here.
Yeah, I feel like terrible. Your definition of terrible is not
like
my
15.
definition. Yeah. So I think that a financial advisor can add a lot of value at any stage of life, just like you. Like we've talked about this on the show before. Like seeing a financial advisor for insurance, most people can get insurance through super, or you can go to some insurers directly, like Noble Oak or one of those ones. But I think the number is something like 5 out of 7 of the big insurers don't deal directly with the public. So that's a good example of why, if you're going to get the shop around for the best insurance, you might need to see a financial advisor so you can get insurance-only advice. Like we do a lot of work with Sky, and our community goes through them. But the other reason is, I would say, the other thing that keeps people back from seeing an advisor is they're not quote-unquote advice ready. So a lot of people see a financial advisor at a time when they're somewhat in a crisis or somewhat in need of emergency, like desperate help. That it's good to reach out to an advisor, but unfortunately, there's not a lot an advisor can do all the time in that regard. That's why we have things like the National Debt Helpline. We have free financial counselors. We have money coaches. We have good books and resources. And that's why Rask provides podcasts like this, because in those moments, seeing a money coach, an accountant, or something like that might be a quicker fix. And then in the future, you see an advisor. Final thing I'll say is that remember this, that financial advisors are forward-looking. So the time to see an advisor is when you're planning for the future. If you're thinking to yourself, oh, I'm going through a separation, I'm going through this or that, pick up Gemma's book or speak to an accountant, or try and filter first. Sure, have the free call with a financial advisor, but just know that they might not be able to help you immediately because you might not be ready for the advice. There might be other steps that you should take first. And hopefully they'll recognize that and they'll prompt you to those things first.
And one thing I'll say is, a lot of the time I hear people say, oh, I went to a financial advisor, and they will perceive it as a bad experience because maybe it wasn't the right fit, or it wasn't the right time, or they were not impressed by the fees, or the service, or whatever it was. But that was just one point in time, or that service. It wasn't the right fit. It wasn't the right personality match, or whatever. And I'm just like, if we get the wrong service with mechanics, if we get the wrong start of marriage, we tend to try again, right? If you get the wrong financial advisor, give it another shot at some point again. Don't just be sworn off the whole industry. You have to meet with a couple, you have to give it a shot down, and you will find the right person for you. It's just about working out exactly what you need, what your expectations are, who you are looking for, and what that service looks like. So
Absolutely.
Give a few a shot.
Yeah, I love that, because you've always said that you don't swear off mechanics for life, do you? You just find another one.
Yeah, you don't go, oh, I'm just going to start servicing my own car. You just find what you actually need from the person. So
definitely.
Question number 7. Is it okay to have Soulpats as part of my core portfolio instead of the usual VAS or A200? Owen, quick answer without giving any personal advice.
Well, yeah, we don't know who this person is, so that's fair enough. We don't know who they are. We're just talking about portfolio construction. Yeah, I think it's okay to have Soulpats instead of one of those. Like a lot of the financial independence people will use Soulpats, or like a LIC, listed investment company like Argo or AFIC. Like Barefoot Investor talked about those types of things in his book the first time around. I think it's fine, but I would say this. I don't think you need to have a choice between the two. You can do both. So you can do a bit of Soulpats and a bit of VAS or A200. Just for people that aren't familiar, or this is your first podcast with Rask, VAS and A200 are examples of ETFs, two of the most popular in Australia. And then Soulpats is a company. So it's different. It's a company, and the other two are ETFs. Soulpats is probably one of my favorite companies in Australia. It's been around for over 100 years. If you've walked past a Soul Pattinson chemist, that's where it gets its name from. It does way more than just chemists these days, but that's where it gets its name from. So I don't have a problem with either of them. We own VAS at Rask, but all three of them are good.
Excellent. Are investment fees for superannuation tax deductible?
Maybe this is one for you because you've done so much with super over the years.
Okay, so this question, I was actually chatting to the person on social media about it. So I kind of know a little bit more about where they were getting with this. So the question is, what they're intending is, can they claim the admin fees and the investment fees that they pay for their superannuation fund, and they're like with an industry fund? So the answer is no, they can't claim it in their personal tax return, but those fees are actually claimed like internally. So the fund takes them into account when they're taking into account, the net return and everything internally with the super fund, but you can't claim it in your tax return. Just like if you can't claim the insurance premiums or advice fees if it was done through super. It's because your super fund, the investment returns and everything is done internally, and it doesn't produce any income that's taxed in your tax return. So it's like a totally separate entity. So you can't claim any of those fees because it's got its own tax umbrella. So that's all handled under one umbrella. Your personal tax return, all the fees you pay like elsewhere under this umbrella is totally separate. So these fees are totally separate with the super fund, and they're kind of like netting it off on your return. So the answer is no, you can't put your super fees in with your personal tax return.
Yeah, it's actually interesting. So what Gemma is saying there, just to add a little bit more context to what she just said, is when you see the amount of money that you have in your super, that's an estimate based on all of those things, like all of the after-tax returns, the fees, the insurance. As an estimate. That's why super funds can be a bit of a nightmare sometimes to deal with, because they've got to calculate all this stuff on the fly and try and make that easy for you to understand. A good analogy for this too might often be that some fees are not tax deductible, but they're built into your value of your investment. A good example is like when you pay brokerage fees to buy ETFs or shares, technically that's not a tax deduction. Even though it's a cost that you incur, it's actually built into the cost of your investment. So in theory, although most people try and claim their brokerage, I should say that, in theory, it's actually built into the cost base of what you're purchasing or investing in. I don't want to get too technical, but there is some good ATO literature around this.
Yeah, I actually was looking at this online the other day, and I found some very conflicting information on different accountants' websites on if you can claim brokerage fees and if you couldn't. And I was like, oh, no wonder people get so confused with this.
Yeah.
It's actually pretty shocking.
It might be the accountants not knowing, first of all, and second of all, it may actually be that they explain it in a way that makes it seem like it's a tax deduction, but it's not. So what I mean by this for people that are struggling to keep up, say, for example, you buy $500 worth of shares, and it could be any share like CBA or Apple or whatever you're buying, and then there's like $10 of a brokerage fee to buy it. Effectively, instead of claiming the $10 as a tax deduction, your total purchase price becomes $510. So then when you sell in the future, your original cost base of $510 is compared to, say, $1,000 if it went up, a bit. And then that means you're only paying tax on, if you're good with maths on podcasts, $490, because that extra $10 is built in to the cost of your original investment. And it's very common for people to make that mistake. But you can use great tools like Navexa we had on recently, and it's all done for you, so you don't have to think about it. That's probably the easiest way to go about things, to be honest.
Yeah, perfect. Well, that's the same as property, right? You don't claim
exactly.
stamp duty and things in the year that you purchased a property. You will claim all of the expenses in the year that you actually release the property and access gain.
Exactly. Yep,
perfect. Question number 9, which we talked about a lot that we were actually going to get to, which is amazing. Okay, so this question it says, Gemma, you've talked about having a family trust while there's no tax benefit for you right now. Why do you have this? Why is this and why do you have it? Okay, so this is probably, I think we've talked about it a little bit on Q&A, but there was also an episode that went out recently with Delene where we talked about family trust. Is it worth it, or sometimes is it overkill? I will link this episode in the show notes because it's great. So I have a company and a family trust set up that I invest through my kids through, and I've talked about having no tax benefit right now, but I still keep it. I'm playing the long game because I have it because I had it when I was married, and it had a lot of tax benefits there because my ex-partner was a lower income earner. So we could distribute income as a family, and it had a lot of benefits. In the divorce settlement, it got transferred to me. The kids are under 18, so I can't distribute the tax the same way, but the setup's all done. It's expensive to set up. It's expensive to get out of, and it's a protection asset. I plan for it to be tax effective again in the future. It just makes sense to keep it and for where I want to build. And so I'm just playing the long game.
Yeah. No, that makes sense.
Yeah.
And this is one of the things that I'm glad you touched on. This is a kind of, I guess, a question about perspective, because a lot of people, when they make decisions to invest in ETFs or to buy a house or something like that, they're often thinking about like the here and now, like right here, right now. What's the cheapest one? What's good now?
Exactly. You got to think about what it could be, what you plan for it to be.
Exactly. And that's always kind of the advantage that someone that's a long-term thinker has always had over people that are short-term thinkers. It's like, what's it going to be? And yeah, you might pay a few grand a year in tax returns and accounting fees to keep your family trust open, but maybe in 5 or 10 years, the kids are older, or maybe you're doing different investments that pay off in the long term. So many different benefits. Now, I also have a family trust. I also have a bucket company. And I thought maybe this is a good way to loop back to question number 2, which was about a bucket company. The reason a bucket company gets its name is a bucket company sits underneath a family trust. So in the case of Gemma having a family trust and she's investing through that trust, imagine the trust gets some dividends from Pearl or Comsec or whatever she's got going on. Where do those dividends go? In a family trust, the money has to pass through the trust and go to someone who will pay the tax. Now, when I say someone, that someone could be Gemma, it could be her partner, it could be anyone really. One of the options could be a bucket company. Think of a bucket like it gets filled up. All the water drips into it. It's a bucket from the family trust and 30% tax is paid. So that's how a lot of people set up once they start to earn a bit more money or something like that. It is a bit more expensive. It's what I have. I'll give you another, just to kind of broaden people's horizons for how you might be able to do this. When I mentioned on the podcast not too long ago that I did a refinance of our house. Well, when we did the refinance applied to our house, but the money was sent to our bucket company. So the money was added to the bucket company rather than in my personal name, so that there I could have the loan against the house and pay that off myself, but the bucket company received the money so it could invest. And this way, you can really, if you get a good mortgage broker, a good accountant, a good financial advisor, they can help you do all of this stuff. And this is when you start to get to that kind of next level where really strategic planning is important. So we're not suggesting, I don't think Gemma is suggesting, and I'm not suggesting that everyone goes and gets a family trust. That's very trendy right now, if I dare say so, Gem, and it's not what I would advocate for at all.
No, if I didn't have it already set up, I wouldn't be setting it up now. I think there would be other strategies and things that I would probably explore first for my personal situation now. It was just that I had this already all set up that was working for me, but there's probably some other way. There's lots of other ways that I could achieve what I'm doing now. But yeah.
Yep. Yeah, cool.
There's lots
Good
of
question.
options. But yeah, it was already there. But obviously somebody's been listening to the podcast.
Yes.
So.
Yeah.
Okay, we've got a couple more that I think we can fit in. Owen, honest thoughts on AI's implications on society?
Cool. That's a really big question. I've been asking myself this for years. I think net positive. We talked about a little while ago, and by the way, I'm producing this great big report and summary of different ways to invest in AI and play the AI thematic over the next couple of decades. So that'll be out. Hopefully it'll be available to everyone. Even if you listen to the podcast, you'll be able to get the report. So Stay tuned for that the next couple of months. We've been thinking about it for a long time. I think net positive is the answer. And the reason that I think that is like, I don't know, we all take this for granted now, but, take, for example, this is going to sound funny, an excavator, right? Like a thing that digs dirt out of the ground. When the very first versions of like diggers came around, everyone who was paid to dig holes for a living lost their jobs, right? But then it gave rise to all of these other benefits in society, and people could just drive the digger and the other people could get on with doing other things for society that added value. And so there's a lot of fear and intimidation around AI at the moment, but I actually think it will be a massive unlocker rather than like a downfall of society. Now, of course, there are good and bad, just like everything, like the automated checkouts at Coles. I don't think people really talk about those anymore. I use them regularly when I go, if I go to the supermarket, which is like once every 2 months now. But, that those have been net good. I'd say the other people could go and do other more productive things. So, that's my take, Gem. Pretty short, but I'll come out with more in the future.
Yeah, I agree. I think it's all quite scary at the time, like change. But when we think about like the internet, people hated the thought of that. Phones, like all this technology, but it can be used for good and evil. But at the time, we just grow and evolve with it. And okay, question 11: what to do once your whole home loan is debt recycled? I would say the next thing.
Yeah, it's a good question because debt recycling. We have a lot of clients that have fully debt recycled their house, like a lot of financial planning clients. And so I'm not advocating for this, but a lot of them turn to like investment properties. A lot of them turn to, even some of them have margin loans, which is not me. A lot of them use geared ETFs. A lot of them buy a bigger house and start again. Like there's so many different things that you can do. But if you've debt recycled your entire house, that's an awesome spot to be in. So also just pay yourself a bit of kudos. Maybe go spend 2 weeks in Positano, enjoy some of the money that you've saved up because good on you for getting that far. Like it's a wonderful thing. And I hope you aren't just focused on money in your life. You can actually take a moment to start to enjoy it because that's the sole reason that basically we all build it. So enjoy it. It's hard to slow down, but that would be my tip.
Yeah. But like this is a strategy on being debt, like tax effective, right? But at some point you want to be debt free as well. So yeah, you probably still want to be looking at, you can be tax effective, but debt free at some point too.
Yeah. And you could also pay off the debts, right? You could focus on paying off the debts for once and for all, and then leveraging into an investment property, because sometimes banks won't give you like an infinite amount of loans, right? But if, for example, you've kind of maxed out, you might be now able to be like, okay, well, I'll pay down this amount of debt and I'll get debt on an investment property or some other way that you do it. Like there's many different options.
This person is probably in a really good position to be getting some personalized financial advice, I would say. It sounds like they are very disciplined, are very on top of their finances, and getting some personalized advice just to stress test what they're doing, take things to the next level, whether it's, one-off advice just to soundboard what they're doing. I think they'd probably be in a really good position.
Oh, yeah, definitely.
And the final one, we have flown through these. I'm actually very proud that we actually have got through 12. Okay. Final question for today is, what if your goal is to clean up your finances? Who do you see?
Well, you would know because you're a money coach.
You buy the money reset. I would say, okay, so it really depends on the level that you need to clean up. So this is where money coaches come in, but potentially you might be eligible for some debt counselling, some free financial counselling from places like National Debt Helpline, Salvos, those kind of places. But this is really where a money coach can come in as well if you're not eligible for those services. If you're feeling really overwhelmed with your finances and you're not in a position where you need a financial advisor for strategic advice, but help with those day-to-day stuff, like a money coach would be great. Yeah, Lexi Smith is someone that we work with regularly. Karen Eli, Gemma Mitchell, you could buy the money reset. Sounds like it's exactly what you need.
Yeah.
What would you say, Owen?
Yeah, I'd say I would say, this is where people's understanding in the Rask community is starting to build. This is not necessarily the realm of a financial advisor. A financial advisor will help you, but it does cost a bit more. So
yeah. And you'll get more out of advice if you've already got your foundation sorted. Like go to them already clear on, I got this much surplus, I can do this, I can do that, because they're going to take you to the next level and they're going to be expensive, but valuable. So go to them with already your stuff sorted.
Yeah. Yeah. So Money Coach, great book, like you said, The Money Reset. I think Emma Edwards' book is really good for spending and mindset and that sort of stuff.
Yeah, Emma Edwards, Know Your Worth. I'll link that. That's a good one.
Yeah. Also, Queenie's book, which is just behind you there, I can see that as well. Queenie's more recent book. It's about making saving money fun and enjoyable and knowing yourself. I think that's probably the biggest thing is cleaning up your finances. There it is, the Money Reset, Gemma. Thank you.
For anyone who's listening, I'm looking at my bookshelf behind me. I'm holding up Queenie's book, my book. I've just lent Emma's out, so I can't hold hers up. But
okay. But there's plenty of good resources, and I think for most people, we talked about this in a recent podcast, is that not being good with money is actually about knowing yourself. I would say that's probably the first step. Is like, how did I end up in this situation? And is it something in my habits and my routines? And from there, you can kind of make, and your habits and routines, by the way, could have been inherited from your family or friends or people around you. So don't be harsh on yourself. It's okay. We all go through this moment in time, I think. But from that moment, you can use what you know about yourself to make a more informed decision. If you need an accountability person, find a friend or see a coach. If you are in need of debt and you're under severe financial stress, by far the best resource is the National Debt Helpline. Give them a call. They can advocate for you. They can help you find counselors and do all that sort of stuff. And if you're in that kind of middle ground where you're not quite sure, just ask the Rask community. Like, jump onto community.rask.com.au and there's a few thousand people in there now that will be able to help you, including us. So we'll be able to point you in to resources. We've got free courses on this as well.
Yeah, actually, there's some really good ones that, like the psychology of money and stuff, those courses would be really good for this person. I said Victoria's book, which is Know Your Worth. Emma's is good with money, but I'll link them all in the show notes. And this person could also reach back out on socials and I'll send through some resources. But thank you so much to everyone that sent through these questions. They were so good. We had such a variety and we've covered so much. And Owen, you've done so well to cover these off so quickly. Didn't have to hurry you on once.
Oh, thanks. Well, I'm trying to get my social brain in order, like that kind of more rapid fire. And that's what we wanted to do, make it a bit of a social Q&A. And I'm happy that I could fulfill that for you. As number 3 on your list, Gem, I'm very happy.
No, that is great. But for anyone listening, we do these Q&As every Friday. And in your player show notes, you'll see a link that you can actually send in your questions. We love a funny name. Put in as much info as you like and we'll get to those. We're going to put in some gifts and stuff as well, so that if you write in a question, you can get a pack, maybe a book, so if you get some merch.
Next week's show, if your question makes it on, we'll send you a book. So send us your questions this week following the link in your podcast player. If you're on YouTube, it's in the description field there. It's just rask.com.au/question for those of you that are listening. So check it out. Send us a question. We'd love to hear from you. But Gem, this has been heaps of fun. The Money Reset is out soon. So people, get a hold of Gemma Mitchell's book, pre-order on Amazon, Booktopia, wherever you get your books. Go and check it out. So amazing. Wonderful Q&A. Thanks again, Gem.
All right. We'll see you next week.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.